Welcome to TheoTrade. This is Don Kaufman. It's December 20th, 2019, and you are watching the TheoTrade Weekend Update. Happy holidays to all. We're coming in, of course, to some holiday trade inside of the next 2 weeks, and none other than the end of the year. And people, they are just buying everything in sight. And I gotta say, really, the title of this video is long or short. This market is just downright dangerous. Let's actually start taking a look with the SPX and its weekly expected move. I'm also going to talk in detail and really kind of strategize with you, if you will, about the rally. Where do you go at this point? Are you the one that wants to get long at this point, huh? Somebody has to actually be buying at that all-time high that we know sooner or later comes. Whole lot of danger, though, inside of this market. Again, let's start in the SPX and bring up the expected move. So here we go. 20 weeks now in counting inside the expected move. Now, I'm going to leave this one to your own devices. When I say 20 weeks inside the expected move, all right, the expected move in this last week of trade, all right? We just hit the bell 6 minutes ago, and here we are. The expected move, and I want to just highlight this for a moment. People, this stuff isn't important. This is what's driving the market. This is the market. The expected move, okay, was plus $46 or minus $46, okay? That was from, again, this is the start point of the week. The upper level here is the upper edge of the expected move, the lower edge of the expected move. The $46 plus or minus, that effectively comes from the option chain, which of course the SPX is nothing more than an options product, and it drives order flow to the entire marketplace. When I say leave this one to your own devices, 20 weeks inside the expected move, but take a look where we closed. All right, so this upper band right here is somewhere right around 32.15 and change. All right, the expected move isn't exactly a perfect calculation. Where did we end the week? 32.21. We're less than 6 points outside the expected move. I have to tell you, from kind of a math geek standpoint, I know some of you guys are going to have to take medication when you hear this, but I actually calculate that as on the edge of the expected move. People, it just doesn't get much closer. We're talking about a $3,221 product, and we're splitting hairs right now over what? Being 6 points outside of it. And quite frankly, people, we just tagged the edge of the expected move once again, which would amount to 20 weeks inside of that expected move. And there's a few weeks back here where I can actually show you, look at this one. This one's just a few points outside the expected move as well. These aren't even like rounding issues at this point. Less than, $10 outside the expected move is phenomenally close. But listen, we've been saying, you're going to move $46 this week. In fact, I did this Thursday night video that said, hey, I know where we're currently at, but expect that we're actually going to tag this upper edge. And that's precisely what we did, because when it comes down to it, the volume in markets today, you'll hear that, overall volume in markets, it's actually kind of light, but the volume inside of some of the index products, specifically here, the SPX, is nothing short of phenomenal. Today though is an expiration. It's a major expiration. The SPX alone did 1.77. For roughly 1.8 million contracts. And the entire marketplace day to day is only averaging between 20 and 21 million, right? You're getting what? Almost 10% of your volume here in the SPX, but the SPX is a contract that's 20 to 30 times larger than most stocks. Of course it's going to drive it. Because it's only 10% of the volume, but that 10%, you multiply it by it's 30 times the size. The SPX moves the S&P futures. Once again, we tag the edge of the expected move. Now, this next week, we got a holiday trading week. What do you expect in a holiday trading week? Of course, the implied volatility is going to be diminished. It's somewhere between $27, $28. Now, frankly, again, that expected move, it's not exactly set in stone yet, not until after the official close. These options are still in motion right now. In fact, there's still volume, okay, that can actually trade through. As you can see, the volume here, it's still moving. If the volume's still moving, the expected move is not necessarily finalized. As you can see, I put 27-ish, but right now the expected move, it picked back up to 28. I'll remind everybody, Monday, the markets are open, full day. Tuesday, the markets are open what we call a half a trading session, of course, on Christmas Eve. Wednesday, they're closed. It's all closed. Of course, Merry Christmas. And then, of course, Thursday and Friday, markets are open. And people always ask me, what happens on New Year's Eve? New Year's Eve, markets are open full day. So we don't take off much time as traders. Hey, open that marketplace, okay? Turn those machines back on. I got in-laws coming to town. What else am I going to do? I'm going to sit here and I'm going to trade, people. With that, so 20 weeks inside of the expected move, we tag it once again. If you're not into looking at these expected moves, again, these are all the hand-drawn ones, you're missing the bigger picture. Everything right now is about this gamma squeeze. And I mean everything is about this gamma squeeze. By the way, speaking of markets, and the SPX, the official close of the SPX happens to be at the bell, but the futures contracts continue to trade the after markets. And the interesting irony is the futures contracts have actually come right back down to the edge of the expected move. All right, with that, quick update here. Hey, listen, the repo markets, Fed's gone wild. There's constant conversation. Is it QE? Is it not QE? Listen, the bottom line, Fed is pumping liquidity in there because it's broken. How about that? Part of the financial system is currently broken, and they are pumping liquidity in here. On another note, okay, in terms of central banks, and I'll keep this brief because we've beaten the repo market to death. And I'm sure that the repo market, we're not done talking about it yet. But, hey, the Swedish bank, which is not something you talk about every day, they're nixing negative rates. They actually raised their rates, even with the economy being soft, simply stating it ain't working. Wow, we really hope here at TheoTrade that possibly Japan and the United States and the entire European Central Bank might actually listen to the Swedish bank, which effectively, and after a period of about a half a decade, raised their rates, okay, back to zero. So from negative to zero, it's a strange world we're in, people. Now let's start to talk about a little bit of the craziness, if you will, in this market, because I say this marketplace is dangerous. Let me elaborate upon what that really means. So I read an article earlier this week, and I'm not a market technician by any stretch of the imagination, right? But I read an article earlier this week, and it talked about the sheer number of stocks in the S&P 500, okay, where the RSI was through the roof. And when I talk about like an RSI, what I'm actually referencing, and I can actually pull up a study over here, just a standard RSI. Like, I'm not getting cute on anybody, right? It's just an RSI, yada, yada, the 14, the 70, 30, hit apply, hit OK. And it kind of said this, all right, on record, there hasn't been, okay, but a handful of times ever, okay, where the number of stocks in the S&P 500 had an RSI, okay, north of 70. So I looked at this inside of the spiders and I thought, oh, okay, this makes sense. And by the way, you can look at the RSI here and it's up there at 73. And then I opened up like a 3-year. I just started with a daily and I go, well, it was way more overbought over here. And over there, ironically, is something that's been compared to. This is early January. This is January of 2018, right before the VIX explosion, right? And that thing got all the way up there. So I started doing a little bit more like regression analysis, and I pulled up, again, weeklies, yearlies, and obviously here's one again, same time frame back in January of 18. And then I said, this is ridiculous. Forget this RSI kind of garbage over here. And I just went to the scanner. And what I did in the scanner is I ran a scan. I said RSI, the RSI length of 14. okay, and a simple. You could run simple, you could run Wilders, okay. Do whatever you got to do, okay. There's 74 stocks in the Wilder scan that come up with an RSI greater than, and I want to enunciate this, greater than 70. If you actually run it with a simple, okay, you get 165. So I'm not exactly sure in that study. It didn't elaborate upon whether they're running a Wilders using a simple. Do you have 165 stocks inside of the S&P 500 with an RSI in what you would term, classically speaking, wildly overbought territory? That's all I want to get to. And, I'm going to leave that again to kind of your own devices, is that, hey, we have an incredibly bullish situation right now. But I'm going to further that. I'm going to further that without just saying, hey, you know what? They're buying everything. Come on, everybody knows that. But when I say they're really buying everything, take a look at things like junk. Okay, here we're actually going to look at HYG. Now, HYG, I've maintained positions, okay, in HYG for years. I like junk. I've always liked junk. I like junk debt. And the reason I like junk debt is because when the markets get downright nutty, you can feel it in junk, and you can feel it in junk. And I'm talking nutty to the upside and nutty to the downside. And I want you to look back, okay, at junk through a little bit more maybe of recent history. And every time the marketplace starts to feel a degree of insanity, junk is right there with it, people. And most recently, okay, look at the last couple of weeks in junk. Now, this is the first time that I've actually brought it up recently here at TheoTrade. And I've been watching it the last couple of weeks. It's one of the most stellar moves that we've ever seen. In fact, again, as I said, go back in time. You see a similar move here, but this is a rebound of the marketplace. Everybody's feeling good. The Fed had a lot to do with this over here. The Fed, they're not, they're in the repo market, yada, yada, okay? The interesting thing at this point in time, and again, look back at junk, as I said, you won't see too many moves that are this staggering. In fact, you can look at it in terms of an expected move. Expected moves, they kind of make everything statistically viable, if you will. And when you start looking at it, and this is an auto-expected move, and I'm going to close up that left side bar. You start looking at this thing, and you're like, okay, so it was inside here, it was inside here, it was inside here. You have to realize, like, junk is pretty much one of the most boring things you can possibly look at until, of course, there's the expected move. It absolutely shattered it. It shattered it and pulled back in, but we are starting to see wild statistical type moves inside of junk. And important point, it pulled back in just the last two trading sessions. We've also got fairly heavy volume. Now, you may attribute that heavy volume in the last three sessions to the expiration. Hey, I'd buy into that theory, okay? But it's 3 days, and it coincided with a fairly key reversal in this particular case. I'd keep a very, very close eye on junk in the days to come. Yeah, I've absolutely positioned myself. Listen, I don't like to talk about anything that I'm not willing to trade. So there are people that just talk about it, and then there are people that trade it. I'm actually using, okay, a very new, okay, duration position in here, in which I'm actually looking for junk to pull back significantly or not. That's fine. And I think we may have actually hit a kind of a key reversal in there. But as I was talking about this, so the RSI scan pointing to just wildly overbought. Newsflash, things can stay overbought for a significant period of time. Then we have junk, and it may have reversed. But this is the really crazy part. They're even buying retail. When I say they're even buying retail, listen, I'm not playing around over here. First one, I want to pull up something like Best Buy. Earlier this year, you really had to question, some of these stocks going to make it? And Best Buy, all of a sudden, there is nothing left to buy. Best Buy accelerates to the upside. Again, when I say they're even buying retail, apparently like it's going out of style. Best Buy, okay, all of a sudden, looks like every other major tech stock over here. They've reinvented the world, and they're up 63%. But again, possibly seeing a reversal today. But it's not just Best Buy. Okay, we'll have some real fun with this. We'll put it on another BBBBBY. So we're actually going to look at Bed Bath & Beyond next. Okay, you know it's bad when they're buying a company that you thought was going to be out of business, people. Take a look at this rebound This is a stock that was down 40%. Literally was actually facing the possibility of a real bankruptcy. It's now up 40% year to date. There is nothing left out there, people. There's nothing left, and they're turning around and they're actually buying stocks, okay, that have, well, nothing. What's nothing? Macy's. It even is catching a bid the last couple of trading sessions. I know Macy's is still pretty much at the bottom of the barrel, but if you want to see some of this logic, also go take a look at stuff like Kohl's. Okay, they're buying it back up. After an absolutely, abysmal earnings announcement, they're buying it back up. Everywhere you look, without regard, without reason, without rhyme, they're buying it. All right. Again, they're even buying retail. When you see junk, when you see retail, when you see RSI scans like this, you start to realize, things are hitting a fever pitch. That's why I'm telling you right now, long or short, this marketplace is dangerous. Now that we've stated a little bit of our case, right? A little bit of our case is, hey, you got the don't worry, though, the Fed's got your back. Until they don't. It's the Fed gone wild. Okay, now that we stated the case, strategizing the rally. Shorts, they're going to get crushed. They're getting squeezed. I know, I'm one of them. Okay, getting short, getting squeezed. Okay, what do you do if you want to get short in this marketplace? There's one of two things you could do. Oh, first of all, what stock do you want to get short? Huh? You want to go over? You want to look at something like a little crazy? You want to go to Netflix? Because in the last couple of trading sessions, apparently we figured out that Netflix must have the cure for cancer because they're buying it from 300, up to almost 340. And that is in 1, 2, 3, 4, 5 trading days. Just to show you this in terms of statistics, we have gone, to insanity and beyond here, people. It's getting there for sure. You're about 3 to 4 standard deviations outside the norm. All right, enough of that. The point that I'm trying to make into strategizing it. Let's say you wanted to get long, you wanted to get short, and I'm going to use something. In this case, I'm going to use EEM, EEM. Now, I've carried positions on and off in EEM for quite considerable period of time. If you wanted to get short something like EEM, there's one of two ways. Either use a duration position. What a duration position? You're buying a deep in the money put. Buying a deep in the money put, it does define your risk, without going too much into the deltas and so forth. Buy a deep in the money put. It's a synthetic replacement. The other way that you could actually get short would be to use something like an in-out spread. All right, in-out spread. Now, EEM is a little bit weird because it's got multiple strikes in here. They had a little bit of a reorg inside of EEM. Nevertheless, use an in-out spread, define your risk. And I can reiterate that again. The emerging markets, you wanted to get short. A lot of people lately have been talking about Tesla, which I will also bring up a little bit later. But if you wanted to get short in something like Tesla, listen, you don't get cute at this point. When I say an in-out spread, one strike in the money, one strike out of the money, and get out. And for those of you, again, you know precisely when to get in, when to get out of this thing, You have to hit your number, and you got to get out of these things. This is how you actually strategize getting short. Even if you're getting squeezed, who cares? Your risk is defined at $2.25. Now, if you want to get long, all right, or if you are long, here's my biggest concern at a time like this. And I got to almost hesitate because, listen, I've seen the movie before. I've not only have I been around this business now for over 20 years, but again, I worked at, startup thinkorswim. We were eventually acquired by TD Ameritrade. So I've seen it all. I've seen this move many a time. And what really worries me is, first of all, you're probably asking yourself right now, how long can this rally go on? Long enough to torture the shorts into absolute and complete and total submission. And when they do, that's when the marketplace will fall. The problem that we're starting to get to, though, at this point in time, where I really get, nervous for the longs. And again, I have no problem. I was just long, a ton of Tesla until midweek when we actually blew out of it. But the problem with the longs, you're just getting baited at this point. And you're getting baited and you're getting baited. And I'm not talking about just long some stock here. I'm talking about your 401k. I'm talking about your IRA. I'm talking about your life savings. Don't get cute. Right now, this is not a time to get cute. What I actually suggest a lot of people do, if you want to remain long the marketplace, I don't mind giving you guys a little bit of education on this front here. Come in here, open up strikes. I wouldn't suggest much more than using about an 85 delta. Go use an in the money call. Why an in the money call? And don't go out more than a week. Why a week? just go out 1 week, use a 85 delta, which is an in-the-money call. Use an 85 delta or around those sorts. You can see I only have 18 strikes open. I'll open up a few more strikes. But get into that about 85 delta, right in that neighborhood. I think the 85 delta is I'm most comfortable with because it's going to give you the most bang for your buck. I don't want to hear that somebody lost, a quarter of their 401k. Because the problem, when I say you're getting baited, okay, we've gone past the point of this ending easily. Now, we could go a considerable amount higher from here, okay? I've seen markets, listen, markets can get, all kinds of crazy, but markets can just get downright ridiculous. And we're pretty close to what ridiculous feels like at this point. But it'd have to get a lot more ridiculous. The problem is that when it ends in such a hostile manner, you're never going to be able to get out. So in lieu of your 401k, I don't care if you have $200,000 tied up in your 401k, you realize you could just carry instead in the money calls for 1 week. You go, what do you do at the end of the week? Roll them out. You go, but there's commissions in that. Roll them out. I don't care. Who cares? Commissions? You have 200 grand or 300 grand tied up. Your life savings is tied up right now. Okay, you're like, but I'm buying calls. There's almost no time value of these in the money calls. All I am suggesting is that you have, okay, a synthetic position. I'm not telling you to buy $200,000 worth of calls. Not at all. Okay, you have to realize one option contract is the equivalency of what? Okay, one option contract is the equivalency of 100 shares. So if you have, okay, and I'll just give you an example over here. If you have a $200,000 portfolio, so you have a $200,000 portfolio, okay? All right, we got enough zeros in there. In fact, you know what? I'll make it even easier. There's a bigger calculator. You have a $200,000 portfolio. There it is. Now we got a comma. Come in here and divide it by the spiders, right? Divide it by, it's a $320 stock, okay? That's what? You have the equivalency at that point of about 625 shares of spiders, assuming that your portfolio mirrors the spiders. So you don't have to go out and buy $200,000 worth of calls. You only have to buy about 6 contracts. So instead of having this ridiculous portfolio, right, you got 6 contracts of the spiders simulating, all right, almost the same thing as having a $200,000 or $300,000 portfolio. And your max risk in here, what is it? Let's get crazy. It's $4.44, okay, per one contract. If the marketplace absolutely outright crashes or this ends badly, you're going to lose that $4.50. But I'm telling you, after a week, roll it. At the end of the week, roll it. At the end of the week, roll it. This is the stuff that trading firms do. Define your risk. What's your risk defined to? $4.40. Sooner or later, okay, this marketplace, you're going to find out what dangerous means. Whether you're long or short right now, you're going to find out what dangerous means. I don't want to give you, okay, that bias. I don't want to tell you to take off your long positions. That's up to you. All I'm doing is strategizing a more effective means. And maybe you don't like trading it week in and week out. No, maybe you like what, $200,000 or $300,000 at risk instead. This is something I'm going to emphasize in this coming week here at TheoTrade and a number of coaching sessions. Back month volatility is still an issue. What I'm saying there, look at back month vol. Go out 90 plus days. Volatility is still high on a relative basis. Okay, a lot of people are like, Don, let's put on a VIX spread. Except the VIX options are not based off of the VIX. The VIX options are based off the volatility futures. If you open up like the 60-day VIX options, the at-the-money strike is somewhere just north of about 16. Okay, so the at-the-money strike, what is it, 1650-ish? Well, all you have to do is go look at the February volatility futures. It'll tell you. There you go. February volatility futures trading 1640. So back month vol is still really high, okay, relative to where it should be. For the most part, what is that telling you? Professionals, they're a little nervous. You should be too, okay? Now, financials. Let's get really specific. They completely stalled out this week. So the financials, the first sign of weakness in the marketplace was junk. Second sign of the weakness in the marketplace, possibly the financials. Let's not forget how we got here in the first place. How did we get here? Okay. I know somebody's screaming, the Fed and outright stupidity. That, people, is a good answer. But how we really got to this level inside of the S&Ps, we did it on the back of the financials. I know it's Apple, it's this, it's that, but we did it on the back of the financials because you can't have an S&P moving like this without the financials. And the financials ripped us higher, and the financials are coming off a little bit. It's curious, right? You see the S&P's up some 13 at the close over here. What carried us? What carried us today? Take a look. Wasn't the financials. Wasn't even the monsters of tech. You had crazy smaller stuff, okay? You got to look at stocks like AMD. All right, yeah, AMD, yay. Okay, we are down to the bottom of the barrel of what's actually carrying this marketplace. Keep that in mind. I'll bring up AMD again. Financials completely stalled out. Now, okay, the reason I'm bringing up financials is you have to take a look at TNX. The TNX, the interest rates have actually spurted up. So this is kind of the reflation trade. The interest rates have actually gone up. The interest rates going up is doing what? It's actually supporting the financials, except that may have also stalled out in the next 2 days. We'll keep a very, very close eye on it. I also believe in the next couple of weeks, I think we're going to get more negative information about not just our economy, but economies around the entire world. Last, but definitely not least on this weekend's update, I like to do what I call a little bit of stock chop, all right, which is a quick run through individual stocks. Got to keep an eye on Boeing. Boeing looks like it's going to crack through 320. If it cracks through 320, it's all over but the crime. There's no hope. If it cracks under 320, this thing could actually see 250 easily. And I think that there's a trade in there. You know, I don't like to get short into the hole. When I say the hole, this is the hole. I don't like to get short in the hole, but a crack under 320, this is almost the opposite, if you will, of what I saw in Tesla. I got bullish in a stock that was moving up. Well, this is one where I may get bearish. One of the things that really strikes me in Boeing specifically, and again, do I have positions? Yeah, you better believe it. I got bearish positions in here. So again, don't talk with the mouth, talk with the wallet, and I've got positions in there. The thing that really bothers me inside of Boeing, check this out, the IV percentile, it is low. So implied volatility is incredibly low. There's earnings like just over 30 days out, and implied volatility is incredibly low. It's like the marketplace doesn't feel the risk in Boeing. The only time it is going to feel the risk is if it cracks under 320. Keep an eye on it. Now, as much as I may hate Boeing, you have to look at United Healthcare, because if Boeing fails, they got to buy United Healthcare to keep the Dow up. Except United Healthcare reversed today. Now we have the possibility of the Dow being in trouble as early as next week. The Dow on a percentage basis, I want you to notice, it underperformed today. You want to know why it underperformed? Because United Healthcare reversed. Keep an eye on it. When I talk about reversed, I mean reversed, people. Sell side activity throughout the course of the day. Now, AMD. AMD goes into, I think, what Jeff Bierman often calls the theater of the absurd. That's what we call it around here at TheoTrade, but 134% year-to-date basis. So this is one where I'm going to let this thing play out a little bit, and I am going to go after a duration short. Again, a duration short inside of AMD. Do I have any positions in there? Okay. A mild position, but believe me, this is one where I'm going to step in, allow it to continue to explode. It's still easy to borrow at this point in time, but you can feel the pressure to the upside. Netflix, we've already kind of reiterated over here, not dissimilar. Netflix seeing an explosive move, almost 4 standard deviations outside. Tesla, here's one also that continued to appreciate, although pulled back very slightly on the trading session. I've kind of talked about this in the Thursday night video, but I'm going to be selling an out-of-the-money call spread. Not because I want to get bearish, because I just don't think it can go that much further. And last, but definitely not least, you got to look at the XHB. Okay, XHB, week in and week out, I've talked about it. It's still waffling back and forth, having an up day today. Nevertheless, in-out spreads, they're kind of working in here. In-out spreads, those are spreads, one strike in the money, one strike out of the money. All we need is this oscillation back and forth, and it's been working. I am still also carrying, though, duration short positions inside of the XHB. Listen, there's a lot to think about. I want you to focus, though, on the idea. Listen, at this point in time, I don't care whether you're long or short. Market is just downright dangerous. Strategize around it. Don't get caught. Okay, if you're caught short right now and you're panicking, find a hedge. If you're long right now, maybe use some type of stock replacement strategy, because no one is going to be happy come the beginning of the year. And if you are happy, it's only going to be a matter of time before you're going to be very unhappy. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday. Hey, we're going to be broadcasting all throughout the course of the next 2 weeks during the holiday season. Bye-bye.